Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day everyone, it's Liam Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show. And if you're like me, you read every day about the world of real estate, about the world of property. And I have got a guest in today who is an expert to take us through a few areas that have been dwindling and on my mind for the last few months. And that is, of course, investing in Victoria. Everyone seems to be talking about Victoria at the moment, but a few personal experiences that I've had just over the last few months. I've been buying in Victoria myself, and people are still asking, why would you do that? That's not where people are going. And I beg to differ. So I've got an expert taking me through that, but also a little bit of uncertainty, not only in Australia, but in the global economy. And I'm joined by my good friend, Sam Gordon from Australian Property Scout, and also actually the winner of the REB Thought Leader of the Year for the Real Estate Thought Leader of the Year. Mate, welcome back to the podcast.
Thanks,
How you
Liam.
going?
Mate, it's always a pleasure to be back with you, buddy. Yeah, man, it's doing really well, man. It's doing really well. Thank you.
Big year for APS.
Always, mate, always. So it's it was cool to take out the industry thought leader. Didn't really think that much about that one when sort of the team threw me in with it, man. But I guess we do things very differently to anyone else in the game.
Yeah.
We're known for that, and it's I guess cool to sort of have the business wide sort of recognition from that as well. So it's cool, man, and looking forward to another big year ahead.
Well, you and I were talking that night, the night that you won. You were like, Thought Leader of the Year. It seems like such a random thing to win, but I was like, well, I think you've graduated into Thought Leader, right? Because with School of Property, you got thousands of people that are learning, right, and listening to your expertise. You've created this kind of educational system that are taking people through the fundamentals of how they can secure financial success through property. And it's graduated from being just buyer's agency services, right?
It has, man. It has, definitely. And look, I haven't really called us a buyer's agency for quite a few years now, because I don't just see it as that. Like, to me, buyer's agency is just like, oh yeah, you come in, you get a deal, you move on, sort of thing. And I know a lot of businesses, almost all businesses, operate in that way. And man, we've never really been like that. And so I guess kind of like acknowledging that we aren't like that, and that we are, I openly say on podcasts, like, if you just want to come and do our deal or something like that, we're not the buyer's agent for you. If you want to come and have like a wealth creation, a journey, a company that wants to really build wealth creation in a big way for you, and that is the actual goal, not just a deal, then that's a company that we are. And so, yeah, man, like, I'm very proud of, I guess, what we've done over the years, and kind of how we've, exactly, you said, sort of like graduated or evolved beyond just being a buyer's agency. And it's funny because Dawn came up and sort of gave me a hug after she won her award. I gave her a congrats, and she said, it's funny because we all kind of look at you at this different, you're this different sort of level now, you know what I mean? And it was just like, it's like, it's so nice to say, and kind of, I guess, hear from that end as well, that it is so different now and kind of viewed differently, because that's how we evolved, man. And like, again, we don't just buy our deal to deal for clients. Like, we see so many clients now that are 6, 10, 20 properties into their journeys over a 2, 3, 5 year sort of window, and are really closing in on those real goals that they set for themselves as well. So 100%, man, we don't look at ourselves as a buyer's agency. We haven't for years. And I guess it's cool and a little bit different to win an award like that. That sort of typifies it.
And look, we've got a pretty bumper podcast today. So the theme of what we're talking about today, Sam,
some cool things to discuss, man.
Some cool things to discuss. And actually, you and I were having a chat before we hit record, and it seems like the number of things that we're going to run through, it's probably going to be quite a long potty. But
I think the thing that we're going to start with is obviously everything about Vic, but I think the second half of the pod, which I think is quite prudent to what we're discussing today, or to what's going to happen today, which is obviously the rate decision later on today. But man, there's so much at play in the market right now that I think like that second half of what we're going to dive into there is going to be really, really interesting to sort of unpack, man. So I'm looking forward to doing it with you.
Arguably more important.
Sorry?
Arguably more important part too.
Man,
so we've got to stick through. Everyone's got to stick with us.
Do it.
Now, buying in Victoria. Now, I'm going to start off with something a little bit controversial, right?
Here we go.
You and me recently did a deal in Victoria.
Yes,
right?
we did.
Now, that's not the controversial part. Great buy. I'm not going to give away the postcodes because I can't give away Sammy Gordon's secret sauce. But I thought this would be a good place to start, right? Because all the fundamentals there on paper, it's a great buy. Sure. Actually, I think online it was like, 3 bedrooms and there's a sneaky fourth in the back, all the good stuff. It ticked off all the boxes and great price point. Talking about it just around the barbecue. And this is where all bad financial advice comes from, right? It's around the barbecue.
I'm glad you acknowledged that.
Oh, it's the worst. And then I had a family member, why would you buy that? That is, everyone's leaving Victoria. No one's buying in Victoria. I'm like, look at the economic fundamentals of this place, right? Like it is a commutable to Melbourne CBD. Look at the price point. It ticks all the boxes, right? Even if you just do a video walkthrough, it's great bones, right? Great skeleton for a property. But there is this pervasive idea that, all investors are leaving Victoria. Now, that's where I'm going to cut it. What do you to say to people that are kind of canning this move and saying that it makes no sense?
Look, I think the easy part of this to distinguish immediately is it's the herd, right? The herd mentality is what they hear in the media, what they hear in the news. And what's always the case, man, is they always hear that lag data, right? And so for the last 2 years, 3 years even, like everyone has, or if not even since COVID, everyone's really been canning Melbourne. And for good reason, man. Like the market was in a pretty tough way. The government hasn't been the best there in quite a long time. There's a lot of policies that were very much against investors that were brought in as well. And some of them with good intentions at heart, but just governments that don't understand the way that the market works and also how to really support an economy from that side as well. So, there has been so much negative chat around it for a long time. Now, as counterintuitive investors, what do we like to do? We like to invest against where the masses think are the right way to go or the wrong way to go. A lot of the time, that's where opportunities are. So it's like it's the old sayings: if you want to buy when others are fearful and be fearful when others are greedy. So often when a market turns, and that same person will say to you in 3 years, undoubtedly, "Oh, that was such a good decision. It was the best time to get in. Oh, look at the growth that it's had in this time frame." It's always the way. It's always the case. And so often, we look at these areas and they tick all those same fundamentals as they shouldn't be the right place to invest in at the time that we typically are investing in it. But a lot of times it's because people are looking at the lag data or the lag media hype or all this sort of stuff. Remember, the media are going to do whatever they can to get as many clicks as they can on the negative stories or the positive stories. They don't want the lukewarm in the middle of, it looks like the market's turning. They want investors are fleeing, everyone's escaping Melbourne, the population, blah, blah, all the rest of when the simple fact is Melbourne is equal largest city in Australia. Realistically, with where the lag growth rates are in all the other smallest capital cities in Australia right now, it is arguably the most affordable or one of the most affordable capital cities in the country right now. It's got one of the strongest economies. The market is genuinely, it has definitely turned a corner down there as well. But man, you look at it, it's the same size as Sydney, effectively. It's half the price. The incomes are virtually the same. Brisbane, Perth, Adelaide, all that, man, they've all pretty well overtaken or have overtaken it by a considerable amount. Hobart's, I think, about to or at the same. Man, Darwin's not that far behind it. They're all within touching distance. You know what I mean? Of Melbourne or beyond it. And yet, man, Melbourne is 5+ million people. When you look at the surrounds and the outskirts, you take the 2-hour radius of Melbourne and regions into account, you're talking, circa 8 million people in these vicinities as well. Extremely strong economy. These huge projects that are coming in, like $10 billion rail line expansions, $10 billion, tunnel systems, all the rest of the sort of thing. Man, there's so much money being pumped in down there. And you're at this super affordable price point. And now you throw the fuel on the fire of the 5% deposit scheme being at what it is and the absolute movement of first home buyers down there in the marketplace, stock that's absolutely fallen off a cliff. And it's like, so if we throw all that out genuinely into the equation of the media saying, all these people are fleeing versus what's actually happening on the ground and where it is sitting from an affordability perspective and everything driving the market, other than yields, which again, yields are relevant to just a scenario and a situation anyway. But other than yields, why are we not investing there? Like that's more the question that I would ask. And so if the only thing that was ruling someone out was their ability to hold an asset at a certain yield, at a certain negative cash flow, there doesn't really beg the difference of like, why else wouldn't you get in there? Right. And so, yeah, man, that's pretty much the easiest way that I would look at it and that I would pick it apart. And it's funny, man, like the masses who aren't investing or who are just looking and watching on from the sidelines are saying those sorts of stories. Anyone that's in the game or that knows the game or knows what's happening on the ground as well, they know it's a very, very different story to on the ground right now.
Well, it's easy to critique from the sidelines.
For sure.
Right? And when you look
without the full picture.
Without the full picture. The data lag, I think, is a very wide wise, very sage way of looking at it, because when you look at internal migration figures, we all know that after COVID, everyone was moving to Southeast Queensland. Like that was a given. You're seeing those internal migration figures now starting to move to Melbourne because there is an arbitrage. You know, if you're if Perth becomes a quote unquote $1 million city, if Adelaide becomes a quote unquote $1 million city, but you can still pick up places in Melbourne in the mid fives, right? Yeah. You know, there is a pull factor for young Aussies and young families to go there and have a very good lifestyle, but affordable.
And both those cities will be over $1 million by the end of this year.
Yeah.
Right? This year as well. You know, like they're there. They're within touching distance of it right now. And you look at the Melbourne as a consideration. You know, the other thing that no one really thinks about, put Brisbane at 2 million people, Perth at 2 million people, Adelaide at 1 million people. The three of those capital cities combined is the same population as Melbourne.
Yeah.
Just think of the gravity, the size of that city. You know what I mean? At a price point lower than those. And arguably, actually, it literally came out on the weekend. Melbourne just won the most livable city in the world.
Yeah.
You saw that, right?
Yeah,
I
did see it.
You know what I mean? Like people love it, man. And like, I've never been a fan of it, but I always like have a dig at, I always have a stab at Melbourne.
Yeah.
But I had it because at 19, I had a hip surgery. I'd never been to Melbourne before, flew to Melbourne, had hip surgery, had a couple of days, flew home. That's why I hate it. And that's the only reason.
And you've ruled it out since then.
But then I was down there for the F1 a couple of weeks. Man, I loved it. It is a great city. And like they say, culturally, it's very accepting. It's so different. The genuinely, the restaurant scene, the eating scene, everything down there, it is really, really good, man. You see so much of the overseas migration also goes to Melbourne, right? Because it is such a multicultural city as well. So, man, I think a lot of those people are going to be eating their words within 12 months when the data finally shows what's actually happening on the ground. And it's now it's just a window of like how long do you actually have to get in before the opportunity's gone and running, and they're, you know, and it no longer sort of makes sense from an investment perspective.
Well, I'm a bit of a fiend for a laneway bar, so I don't mind Melbourne at all. Yeah, I love a laneway bar. Sitting on milk crates outside.
Oh man.
Now, looking at the Victorian market, now we're not going to go into the secret sauce, right? Because obviously those are tightly guarded secrets. If you bloody talk to the whole industry about them, all that work that you've done in identifying these areas will be gone.
For sure.
What areas, broadly, I guess, are good for investors in the Victoria market? What areas are bad for investors? What's your secret sauce in finding areas to invest in as opposed to not?
Man, I think the important thing to throw in here, because there's probably too many areas that are worthy of consideration of buying, and then there's also too many areas worthy of putting in the bin. So I think rather than running through them all individually in that sort of way, which you know is not my style anyway, what I probably would say is the biggest predicator to avoiding and selecting areas at the moment is supply. So genuinely is supply of what's coming online and what's already there. And I think when you factor those two things into the equation, or it's the same thing but on different ends of the scale, that can give you a pretty easy indicator of where you should and where you shouldn't look at, right? Then there's obviously a huge amount of other things to overlay on top of it. Where is in close proximity to projects that are potentially coming online? Where has already seen a lot of growth? Now, from a lag data perspective, there's a lot that actually doesn't come through in the numbers that has genuinely already happened. So where has already seen a lot of growth, and then where potentially hasn't, but is potentially on potential ripple effects from those areas as well, that could have it. And then where has a huge amount of affordability left in the tank that shows the ability to continue to grow and keep growing as well. Because again, it's one of those things that people canned it for ages now, but the simple reality is that it's turned in a serious way already. And there's areas that, you know, have had a certain amount of growth that from a yield perspective no longer makes sense for us because the yields are too soft compared to what the price points are, even if it does have growth left in the tank. But then, there's obviously others that still have great growth left in the tank and also, you know, decent yields to be considered as well.
You've mentioned lag data a few times, just to make sure everyone's on the same page that we're taking them through the journey. Lag data, we're talking like totality, it's 3 months behind. What is lag data? How far can some of the data be wrong?
Man, some of the data can be like quite easily 5 to 6 months is very normal. So in an area where a lot of off-market transactions happen, 6 months can be very normal. It can be even longer because if you look at Melbourne, which a lot of the time Melbourne is sort of like 60-day settlement sort of timeframes as well. So let's say something gets listed online, let's say in say Melbourne, and it takes, let's say it sells and then it takes 60 to 90 days to settle, depending on who buys it. Owner-occupiers a lot of the time will be 90-day settlements. Investors are still, 50 to 60-day sort of settlements down there. It is a bit of a slower process. if it sells off market and goes through from that angle, most real estate agents won't list it as a sold online. And if they do, they won't list it with a sales price a lot of the time. So let's say you're 60 to 90 days. So you're 2 to 3 months in. Then once it hits, it takes 3 months then effectively to get hit in land titles and registered from that perspective as well. Especially with cotality, like that's how long it takes to actually get registered within that. So something transacts off market, you're typically 2 to 3 months there, plus 3 months of land title. You're normally at least circa 6 months of lag data before that actually comes into their numbers from that perspective. So, and especially when markets get really hot, owner-occupiers a lot of time won't want to go to market. They want to sell off market because they don't want 100 people coming through their home in an open home over let's say twice a week for a month. That's a lot of additional stress. A lot of them don't have to go through. A lot of agents will push that avenue as well. So lag data can very easily be a 5 to 6 months lag. Now, if it misses the last quarter by a day, there could be another whole month on top of that it misses as well, right? So that's a big piece that a lot of people forget and miss out on is like if something's a day or a week, 2 weeks, whatever it is, it's like that could also then make it fall into literally the next quarter's data. So it could be like 8 to 9 month lag data with anything that's off market that slightly miss these sort of windows as well. So it's a real thing, man, and that's why that on the ground research and knowledge and presence gives you that real time feedback on what's actually happening there at the time.
Why are settlements longer? And I saw that kind of firsthand. It's like, we're good to go. Oh, and I mean,
throw in the 2 to 3 weeks it actually takes to get to contract as well, right?
Yeah,
so like that's on top.
It's funny, like and the crew at APS, they're good, they're easy, right? And I'm like, like they're like, oh, it's fine. It's just in Victoria. It's just I don't know how to word it. Maybe like a less of a sense of urgency.
Yes.
I don't know. Like, why is it a little bit longer?
It's just a slower game, man. So every state has their nuances, right?
Yeah.
And different states have no cooling off. Different states have 5 to 7 days cooling off. It's different states. You have no building and pest. You have to do it before you even go to contract.
Yeah.
There's just so many different states that have their different nuances, and it has always been very slow to transact down there. There's Form 32s and different things that need to be ordered before you go to contract as well that have to come back from council. So like even as much as an agent or a seller might want to go to contract, if there's things you need to get back from council or from state government, like these things take time. Like they aren't bodies that move quickly. You know what I mean? Like they're government bodies that move slowly. And if we're waiting on those, there's nothing we can really do in that process and in that interim. So man, it's just like literally a state that just goes slow, man. They're just slow operators. It is what it is.
So no need to freak over it.
No
need to be worried that things are falling through.
So here's the difference. I wouldn't say there's no need to worry about it because the simple reality of it, of being gazumped, man, is very real. And so that's where like our agent relationships and specifically buying things off market, like everyone tries to use off market as if it's a fugazi word. And look, it is if you don't have great relationships and you aren't a sharp operator. But if you are, and that agent has exclusivity and you have a relationship with them, they know by burning you of just selling for an extra 5 or 10 grand or even 20 grand or whatever, if they've burned you on something that's been agreed to, they're going to burn a relationship with someone they know that's a good, reputable operator that they have a great relationship with. They're not going to do that. But if you're on market and it takes 2 weeks to come in and you have a price agreed to, but then a 50 grand offer, 10, 20, 50 grand, whatever offer comes in higher, or even if you're off market with an agent, either direct or through a BA that potentially doesn't have a relationship, that you can definitely be gazumped in that time frame of waiting for it to come through. Yeah, we had it happen to us very early in the market in some of the markets we went into because our relationships weren't that strong at that period of time. And that's why, man, as you bolt those down and lock those down over time, that just gets, it's like battening down the hatches on the ship in a storm. You tighten everything in the longer that it goes through, and then it just becomes a simple process. But that lag time of yourself waiting for that contract for 2 to 3 weeks very, very easily could have been gazumped by 10, 20, 30K, which we see happen all the time of other results, especially things on market. So until it goes to contract, you don't know what it's actually going to sell for.
Yeah, okay, that seems interesting because that's, that was kind of the thought that we had. Also, it just seems like the agents are taking a little bit longer, but they also probably trust the process.
Yeah,
it's not the agents.
It's not the agents. No. So it's almost always it's the seller's solicitor or seller's, the vendors.
They're just holding it up.
Yeah, well, they order the stuff, man. So they got to order it. Like, because so often you think about it, if a deal happens quickly, or if someone gets a listing and goes straight to market, they haven't ordered all that stuff, and that stuff could take 2 to 4 weeks to come in, depending on the council, depending on, it would typically depending on the council and depending on the speed of the seller's solicitor. Because if they're used to moving slowly, then they may just go, oh, well, whatever. we'll do it we'll order it when it actually goes under contract. Because if it doesn't sell, you don't want to have to pay for this stuff.
100%.
That's what happens a lot of the time.
Yep.
And then so, man, the agent wants to get it on contract and move to the next deal.
Yeah.
Every agent, or nine times out of 10, an agent will want to just get it to contract and move to the next deal. They don't want to fluff around for an extra 5, 10, 20 grand. They just want to get the deal done and move on.
Yeah.
Or in my opinion, the smart ones do. So it's one of these sort of tricky scenarios, man, that you've really got to navigate and almost negotiate your way through. So it's not an easy process. And that's why I think, especially with how hot the market is at the moment, having a great BA on your team, being able to handle and manage those processes, it is super important.
Absolutely. Now, one of the challenges with the Victorian market is that it often does have lower rental yields than other states.
Sure.
How should investors approach this challenge?
Man, it's a great question and something we got hit with a lot. Now, the very simple fact, man, is Victoria, yes, does definitely have lower yields than almost every other state and city in the country, right? Simple fact, though, is, and I liken this a lot to Queensland, right? You say far north Queensland, but man, I got properties in Gold Coast, I got properties in Logan, I got properties in Ipswich, I got properties in Moreton Bay, and all their insurances are crazy. You know what I mean? Not crazy, but they're expensive. All their council rates are expensive. And it's the same as when you go to, Rockhampton, Townsville, Cairns, all this sort of stuff, Mackay. Man, they're all expensive. And the further north you go, the more expensive they get, right? But people will look on paper at the 5.5% yield they might be able to get there at the moment, or let's say 5 to 6% in Queensland, right? They look at that 5 to 6% in Queensland. They go, oh, well, it's 5 to 6% versus, let's say, 4% in Melbourne, or in regional Vic in some areas, depending on the price point of what you're buying. But they're not looking at the net return. Now, net is typically something we talk about in commercial. But when, because that's obviously the way that we calculate income in commercial. But when it comes to residential, it's actually quite prudent to bring it into the consideration when it comes to areas like this. Because, if you're buying a property in Victoria and you get your council rates are $1,500 a year and your insurance is $1,500 a year, right? But your yield is 4% versus something in regional Queensland where you might be getting, say, 5.5%, but your insurance is $3,000 a year and your council rates are $3.5 grand a year. When you actually factor in that extra, we're talking $1.5 to $2,000 per each of those utilities. We're talking $3,000 plus a year in additional expenses that, most of the time you're not really accounting for. So, because on face value, people are just looking at that gross yield. So I think it's really important to really understand the dynamic within that. And the other piece, the other component of it for me, I'm always very much an affordability scale and affordability metric investor. I like to understand what I believe a market can get to, where is it at currently in the cycle, and where do I believe it can get to, right? For me, I definitely put Melbourne and a lot of regional Victoria in some of the strongest growth market positioning there is in the country right now, right? I'd back it over most of the rest of the country. And this is where it really comes into the individual investor and what they actually can afford to hold from a negative cash flow perspective. You're buying in Victoria at the moment, you're almost undoubtedly in negative cash flow zones, right? Just where we are with interest rates, it is what it is. For me, I look at this as a cost of doing business, right? If something's costing me $10,000 to $15,000 a year to hold, but I firmly believe that area is going to produce 15 to 20% capital growth in that time frame. So I'm going to be up circa $100,000 in the year, and it's going to cost me $15,000 a year. Plus, obviously, I can write that off. If I know it's going to produce that, and I'm very confident the market is going to produce that, that for me is a cost of doing business. Now, if the alternative is going and buying in another area that's maybe got a 5.5 to 6% face yield on it or gross yield on it that looks decent, right? And maybe it's running $5,000 a year net negative, but instead that market does 5% worth of capital growth, and maybe I get 20 to 30 grand capital growth, or nothing if it stagnates. Which is the better investment? Like, it's always going to be the one. Yes, it might cost you a little bit more to hold in the short term, but if we're getting significantly more capital growth, it is a significantly wiser decision. Because what are we in the market for when we're buying bread and butter growth style assets? It's for growth. And so it's one of these things, man. I know a lot of people canning it from that perspective, and I avoided Melbourne and Victoria until I thought it was really the right play for market entry versus other markets in the cycle. And man, I think it's quite simply, with where it is right now and where other markets are right now, still to me, it makes a lot of sense. Now, if you were first timer coming in and you couldn't afford to do it, or if you're first timer coming in, all you can do is afford to do one deal or two deals, carrying that negative cash flow in recompense of getting that massive capital growth, if that's what we believe we're going to get out of these specific areas, I would take that gamble. I would take that risk. Because comparatively looking at other locations, I don't think they warrant it Again, there's a couple that could potentially be a bit better. But again, man, negative cash flows are a harsh reality of all growth assets in Australia right now. So it's cost of doing business.
And going back to, you and I were talking about this before we clicked go on the podcast, but the world of investing now is different to what it was 30 years ago. And to a point, we have to go back to the basics of you have to be able to weather the storm to a point, which is a few interest rate rises, which is a little bit of negative cash flow, which is insurances and taxes, right?
I'll say one thing real quick, right? I bought my first property in 2009. I was on minimum wage. I think I was making about 36, 38, 9 grand, something like that a year, right? I bought my first property. It was yielding about 5.5%, but it was a unit. I had body corporates.
In the gong,
man. That's the one, right? Man, when I bought that, my interest rate was at 7.19%. Right? People are still getting interest rates right now around 6%, right? Yeah. So it's like... We're just really at when you're hovering around that sort of 5.5% to 6.5%, you're at long-term interest rate averages, right? And I think people have to really look at what are they doing? And are they going to take time out of the market just because interest rates might go up a little bit? Yeah. Or do they, understand the fact that this is a cost of doing business over this time frame? And man, it's just, it is what it is in the scheme of things. But what do we do as investors? We keep pushing forward, we keep moving forward because we have the greater game plan in mind to succeed. Now, for every $1 million worth of debt someone holds, let's say someone holds a 2-property portfolio, $700,000 properties with 500 grand worth of debt on them each. If interest rates were to go up 0.5%, which obviously it's still in times where yields aren't great, it's still a bit, it's $5,000 a year, right? 1 full percent interest rate increase is $10,000 a year. Now, yes, obviously it is an expense that you're going to have to incur, but man, we can also write that off tax as well and get that down to a certain amount. But it's again, if we can do 2 deals, or if you could acquire another 2 deals, carry another $1 million worth of debt, and it did cost you an extra $5,000 or $10,000 a year to own those deals, but then if those properties again went up 50 grand, 100 grand in capital growth in the year, everyone's going to take that, right? If you could give someone $5 and they give you 100, you're going to do it every day of the week, right? So the key is obviously making sure you get the market right. And you also need to be able to afford the negative cash flow that's associated with it. But mate, it's a cost of doing business, something people have to look at and understand that it literally is just part of the process, part of the cycle. And there'll be times where interest rates come right down again, not probably to what they were in COVID, but they'll come off a cliff at some point. There'll be other times where they do ride back up again. It's being more sophisticated, more educated as you get further along the journey, consolidating the wins, banking the profits, clearing that low yielding debt over time, acquiring some good, say, commercial assets that can balance out the cash flow of the portfolio. But if you're early and you're accumulating, don't be put off by interest rate increases or chatter around it. Again, look at it as the opportunity of when other people are going to maybe hold back and be fearful, is that your opportunity to maybe make a little bit more on the way into a deal or get access to a market, get in earlier. We always look at these as opportunities.
Now, not to make it political, but I think this is a good time to ask this question, which is, we were talking about the 5% deposit scheme before, right? And, it goes up to $1.5 million in Sydney. So, I mean, realistically, what's $1.5 million going to get you in Sydney? It's probably a house, right? It's probably a unit, right? Yeah. In an oversupplied area. And realistically, if you're only able to put down $75,000 for a $1.5 million asset, you don't really have much demonstrated ability to save.
Yes.
It seems to me that these people are probably going to be at most risk of the brunt of interest rate rises.
Yeah.
What would you say to someone who is sitting there at home listening to this, doing some professional education of a rent vesting strategy? And I know it's something that you and I have spoken about before, but I think it's more of a pointed time to ask this.
Yeah.
Because if you do have 3 additional interest rate rises, what that takes to 5, you're kind of halfway to that 3% serviceability limit that the banks test.
The buffer,
the buffer. What would you say to a young Aussie that's weighing up the 2 options?
Rentvesting versus buying
with a 5% deposit scheme. Yeah.
Man, I think in that scenario of, say, Sydney, where you are talking about 75 grand, deposit to get into a deal, you're not that far off the ability of being able to go out there and actually start the journey of, let's say you need 100 grand to get into your first deal, and doing things that are significantly more affordable from that perspective and actually growing genuine wealth. Man, I think there's a lot of heat in those markets, sub those brackets that the 5% deposit schemes sit into. So, the 1.5 mil for Sydney, you're not getting yourself a good deal at the moment, right? There's a lot of heat out there for that style of product. So it's one of these things, and there's a lot of, like the IMF came out, the International Monetary Fund, and called on the government to pull that, and especially for existing stock, like to make the changes to it. So again, if that happens and that demand gets dropped from that perspective, does that potentially create negative equity in some of those properties that were a little bit overheated at that price point for what it was? Now, I'm not saying that that's going to happen, but like these are the realistic sort of parameters that we're playing with in the market that could potentially play out. Now, if we were to flip that on its head, as you said in the secondary argument of, well, what if you rent vested instead and went in invested somewhere else? So live where you want to live, rent where you want to live, and then go and invest where it makes the most sense. Now, if people actually worked out the differential between owning, especially at the moment, let's say interest rates 6.5%, maybe getting to 7% if they do another 3 interest rate rises. Man, if we look at the difference between that holding cost of buying an asset, I'd say 1.5 mil, at a 95% 95% LVR versus renting in that area, and let's say that area was $1,000 a week to rent, which sounds like a lot. But let's say it was, which it probably realistically is. You go and rent that, and then you go and invest in somewhere that makes sense, the most sense from an investment perspective, and then you try and recycle that deposit back out into another asset. Let's say in potentially 6 months, or even 9 to 12 months, whatever. So let's say at the end of the first 12 months, you got yourself 2 properties in the scenario we were talking about before. All of a sudden, you've got almost the same amount of property at play, gross asset value at play out there in the marketplace as you did with the 1.5 mil unit purchase. But your living costs are substantially less. You've got other people paying you rent to go towards those mortgages that you've obviously, picked up with the 2 deals that you've got. And then, in 6 months, could you strip equity and buy another one? Then that gives you 3 properties. In another 6 months, could you strip equity and buy another one? That gives you 4. Realistically, when you get beyond 2 properties, you get to 2, 3, 4, it becomes very easy to strip every 90 to 180 days, every 3 to 6 months, right? Becomes very easy to start doing that. Now, if you also understand how to manage cash flows, if you also understand, how your cash flows do look overall, and also throw into the equation, if you were able to buy at 95% on that style of asset on a 1.5 mil, your surplus cash flow is probably okay to hold, right? And so, could you keep scaling and building a portfolio from that perspective until you could actually afford to buy what you want to actually live in, rather than just what you can afford to buy due to a 5% deposit scheme? And so, man, that's the way that I would really look at it. And I've had this conversation with different people before, and they've asked me, well, what if that is genuinely the only option I've got to get into the marketplace? Well, if you couldn't save a deposit to get into another property for, say, 12 to 24 months, then I would say, yeah, do it. Jump in. If it makes the most sense, if you think you can get a decent deal, and, if you believe that market, or if the fundamentals are there for that market to keep kicking, then 100%, go and do it. But if you've got the ability and the choice of the 2 options, I would be going for the rent vesting strategy. Build the wealth, through a vehicle that actually makes sense over the long term, not just something that's potentially a short-term hype and a fad for now.
Well, you're far more diplomatic than I am. I've been pretty pointed with the 5% deposit scheme because I just see all these young Aussies, right? I know I talk about this on so many podcasts, but it's like, it's almost become like a game to me, like a very morbid, dodgy game. But, you go on realestate.com.au and pluck any apartment in Parramatta. Pluck any apartment in Parramatta, look at the sold history of it, and half the time they're selling for less than they were 10 years ago, right? You have, and you use the word for negative equity. I see that there is such a risk of these young Aussies moving into oversupplied markets and putting themselves at risk of negative equity, especially if you're buying them at over 800K and you still have to pay stamp duty on the way in, you're still paying seller's costs on the way out. And just and I know one thing that you always talk about, Sam, is the holding costs on the way through, which is why you don't buy in stagnant markets for the sake of buying in a stagnant market. You've got all these months and years of just paying interest for the sake of paying interest, and then on the way out, your asset's worth less. I'm a big advocate of thinking outside of the 5% deposit scheme. But before we get on,
I just want to recap one thing with that. Now, just to recap on one thing. I said if you can't get into the market for 12 plus months, then it is a consideration, because I think it is. And I think something you're about to dive into in a second is around this potential 2-class economy that we're undoubtedly moving into, right? Now, the reason why I say that, and I preface and I bring us back to that, is because if a young kid was like, oh no, it's all good, I'll save a bit more, or I'll try and get into this, try and get into that, or if they genuinely don't have enough of a deposit to go and buy an investment right now, and that was going to take them 12 to 24 months to save. Right now, if that was the equation, if you couldn't save enough of a deposit within 6 months to go and invest and then build a rent vesting strategy, I would embrace a 5% deposit scheme, because I do think the way the government is setting us up right now, they're setting us up to create a massive gap in the market which I think is going to come into effect probably in the next 2 to 3 years max. And I think we are going to create a serious flaw in the market that we've never really seen before that's coming, especially if, they keep talking about potential changes to CGT, all these sorts of things. All they're doing is making people stay out of the market from selling for longer. The longer the people hold, the more the prices increase. And, we'll touch on a few things from an investment perspective with this in time. But this is where I'm sort of saying is if there was no other option on the table, I don't believe in it as a strategy. If there's no other option on the table and it's like, and if they weren't going to invest, then yes, I would say get amongst it and go buy your own home. Because I think with the government just doesn't understand what's at play at the moment. And we see this by the 5% deposit scheme came out. They never ran the numbers on it until 2 months after they announced it and approved it. Then they ran the numbers on it. And then they came out and said, it's going to be 0.6% growth.
Over 6 years.
Over 5 or 6 years, whatever it was. And it's like, mate, it did 10% growth when the words were out of your mouth.
Yeah.
You know what I mean? Like to say that it's not going to come and it's not going to happen is absolute fallacy. These guys have absolutely no idea what they're doing. They're playing with the literal fabrics of the whole economy and what is built and what all the wealth is built in. So much of the wealth in Australia is built in people's own homes, right? And they're taking that away from the generation that's coming through. Now, I say this with a vested interest, right? I say this with a vested interest of if everything's at play right now, I'll be worth tens of millions of dollars more in the next probably 3 to 5 years than what I am right now because of the growth that's undoubtedly coming, because of these changes they're bringing into the equation, into the market. But I'm saying it with the conscience side of things that if this does play out, like, my kids, whenever they come into the fold, and realistically, just anyone that can't buy for the next 5 years, there is going to be a gap that's going to come in. You throw on the very simple equation of the building crisis we're in at the moment, right? The housing crisis is fueled by the building crisis, the lack of building crisis, yeah? And so we're building roughly 120,000 homes a year, 120, 150 at absolute best. We need 250 a year. That was 3 years ago. We needed to hit 250 a year. We haven't hit that 3 years in a row. It's only becoming more and more of an issue. The population is only growing more and more from that perspective. This wealth gap is becoming serious and the divide will become serious. And I think like the longer that this thing stagnates, and what a lot of people don't realize is if they bring these changes in, right? Now the IMF came out, that's the International Monetary Fund, okay? Literally the overarching body of all economies on earth, in the world, right, had came out and said, Australian government, what you've brought out is lunacy. It is idiotic. You need to change it and you need to look at cutting some of these policies because what you're doing right now is going to literally stuff the economy in the way that it is run, right? You're going to create potentially an asset bubble with the way that it's moving here. And the very simple fact, right, I'll break it down for you in the way that I believe it could play out. If they bring in things like CGT discounts and slashing those, right, this won't affect, people don't realize that this will not affect professional investors. This will not affect in the most marginal way. It'll affect sophisticated professional investors, those of us that know what we're doing, right? It is going to be a benefit for us. Yes, in the short term, CGT discount parameter, it literally is a couple of percent. It's not that big a difference in terms of how much we'll lose out from that capital growth perspective. But what's going to happen is people will hold properties longer. That means less stock, which means higher prices. Investors, mum and dad investors that aren't sophisticated investors that just previously were just trying to, carve out their own little piece of wealth in Australia, they're going to get spooked by this thing and they're not going to buy. What is that going to happen? What's that going to mean? Now, at first, it will probably balance out the imbalance of less people coming to market and selling. But what will happen over time is less mum and dad investors coming in and buying will mean less rental stock. And as the 5% deposit scheme creates this floor under the Australian housing market and pushes it up, combined with the CGT discounts, meaning people hold property for longer, which means prices continue to keep going up because supply is less and less. Then your mum and dad investors, which make up, 3 million investors in Australia, so 92% of the marketplace, if they stop buying and if they stop injecting rentals into the marketplace, what happens? Less rentals, tighter vacancy rates, higher rents. Now, what happens in that equation? Higher rents means it takes significantly longer to save a deposit because you don't have as much surplus cash flow. Prices are now all of a sudden at this level that has never been seen before. So prices, like houses are harder to get into from a pricing perspective. It might take you 5 years longer to save the deposit. So where do those two actually marry and come together and the ability to get into the marketplace? It doesn't happen. So what I believe is going to happen if this continues to transpire the way it's going is we will move into a two-class economy when it comes to asset ownership. I firmly believe that's going to happen. And then if that happens and people are just waiting to inherit, again, we were having this chat offline. If people are waiting to inherit their parents' properties, mate, you and I, like our parents' generation are living to the 80s. My grandparents lived into their 80s and into their 90s, right? Hopefully my parents live into the 90s and potentially beyond. Mate, our generation is probably going to live to 90, 100 and beyond potentially, right? That could be the average. Now, if you have kids at 30 and you die at 100, that means they're not inheriting your house until they're 70. So we're just going to have generations of renters until their 70s. This is just going to get worse and worse. And the reason why I bring this up, man, is because like we've done a lot of deep diving into this thing, and we firmly believe as asset holders and who we are right now, we will benefit enormously from this, right? But this isn't something that I even kind of really want to see happen from this effect. Like it is a lot broader and it's a lot more drastic than I think should be at play. I love it when the market's very, you can calculate it very simply, right? And very effectively from that end. It makes it easier for me to do the job, and we always have different places we can go to next. When they create this floor across the country, they're just creating this massive gap that's just going to come. And then what it's either something pops, which I don't think it will, or it just creates this massive wealth divide. And that's what I firmly believe we're moving into, this wealth divide. And that's what we're talking about of like, if someone does, like if we don't bridge that gap and if people don't get into the marketplace in the next 6, 12, 18 to 24 months, if they don't get in at all, like, especially if they bring some of these changes into, where does the market actually get to, right? And so that's where I genuinely believe we're moving to from that perspective. So I know it's a long-winded way of sort of getting around it all, but it's like a genuine sort of risk for the next generation. Again, those of us that are asset holders, man, we're going to be able to keep leveraging off what we have growing, what's already building, what's already in the portfolio. But those that are beyond it, there's a serious issue at play here.
And it's ironic, you know, I find it's really the most sophisticated investors and like, you know, yourself and Phil Tarrant as well, that are the most hesitant with the 5% deposit scheme from an ethical point of view,
100%.
Which is like, hey, you know, we are set here to earn a lot of money because of artificial government demand being pumped into the market. But at the end of the day, it's like we actually do have like an ethical consideration here to say this is just, you are burdening future generations. At the end of the day, you want safe, stable, long-term growth. You don't want some 2008 market which is artificially inflated, all for it to pop at the end of the day. There's also one other thing here which I think a lot of people aren't talking about, which is the government's. You did highlight it, and I think it's worth going a little bit further into as well, which is insolvencies in the construction and building industry are already at all-time highs. It's also a highly leveraged industry. Why? Sure. Because if you build new house and land packages, if you're building new apartment unit blocks, it's a very capital intensive thing. You get loans for it,
and margins are skinny, man.
And
so
margins
the more
are tight.
Debt you have out there, the more irons you have in the fire to make more money. But the margins are skinny, man.
So, and there's two ways. There's two things that's going to happen. One is 3 potential interest rate rises, which is going to increase the price of that debt, but then also the flow-on effects of the global geopolitical uncertainty in terms of costs of material goods coming in from overseas. Sam, love to get your insights, but I don't think it's outside of the realm of plausibility that our supply realistically in the next 24 months is going to maybe grind to a halt. It's a bit dramatic, but it's going to seriously taper off.
Yeah, man. I think, look, the realistic component of this is that's been in effect since COVID. And the government had the ability post-COVID to open the doors and let in a load of skilled labor come into the country and plug the gap that we had that was a trade deficit. They didn't do that. They let in 800,000 people that were backpackers, that were, just like unskilled labor. You know what I mean? And like we needed them back in the books because we had our doors closed for 2 years, but they could have done it so much more strategically.
Real estate agents.
Man.
And auctioneers were on the skilled labor list.
Is that right?
Yeah. And martial arts instructors, yoga instructors. Have a look at it. It's pretty wild.
There you go. But man, like realistically, what we needed was skilled labor in the building game. Like I remember, builders sending me screenshots of brickies in WA in their massive Facebook forums of these massive groups, man, saying like, well, now's the time to jack the prices. They're going from $1 a brick to $3 a brick, like overnight, man. And they could charge it because the builders needed those people. So all of a sudden, the massive flow-on effect to the clients, and that's where these huge price increases came through, man. And like, they still haven't really plugged that deficit. And so, you look at all this stuff, man. It's like, the cost of labor is increasing. The cost of materials are increasing. You're having, again, these geopolitical, war spaces, which when you think about it, like there's actually a lot at play at the moment that could definitely lead to a lot of different things at play right now. You've got, governments that are taking longer to get actually things to the easiest way to get projects to ground and to actually get supply on the market more quickly is have a streamlined DA process that allows builders and developers to get to ground quickly, get to site quickly, and build quickly. You know what I mean? So like, prices aren't done here, and then 2 years later they're supposed to be able to settle on a deal. That's how builders go under, because that time frame in between, the cost of everything could massively increase from what they sign their contracts at, right? And so
the cost of holding the debt for that long, well, parts of the debt,
all of it, man, all of it. It's all flow on effect. And so, like 100%, I agree with you. Like, but that has been at play since the start of COVID. You know, but no one has taken an active approach in, well, how do we actually solve this thing? How do we create the solution to allow developers to get to market as quickly as possible, actually produce new stock? Like, should we be pushing 5% deposit scheme into new stock and new product like that valves up, you know, at construction costs, and drive that segment into the market into there, as opposed to into existing stock? Like, yes, all these things, if we had a government that was smart at, at housing policy, we would have these things. Instead, they're throwing money at the fire, like thinking it's going to solve it. Mate, it's paper. It goes up in flame. It incinerates, you know, and that's what we're sort of seeing. These guys that don't understand it, guys and girls that don't understand it, making these decisions without actually doing the research first and putting us further and further in the hole. Exactly as you're saying there with both Phil, myself, we spoke about this recently on Scouting Australia on the round table, predictions for 2026. Exactly the same thing. We all have a vested interest in just letting this thing play out, because we'll make a lot of money from it from that perspective. But ethically and like two-class economy-wise, is it the right thing to do?
No, you're paring yourself back. You're like, actually, we're about to get too rich, which is bad for other people. You know, it's ironic.
All asset holders, man, will fall into this category, right? Which is great for asset holders, but it's not for the next generation, you know? So, and I think it's like, and we not to go dramatic on it, but it's like when you create that, you know, we're going to create undoubtedly like a build to rent scenario in this country. Now, if we do create it on such crazy scale that is what it moves into, from that perspective, you know, what does poverty start to look like in Australia? It was always seen as an exceptionally safe country, right? But if you have a huge amount of people that will never be able to own their own home, and then if hold periods become really, really long and mum and dad investors no longer get in the marketplace, does it then evolve into people more homelessness, which it undoubtedly will, because if prices go through the roof, less people can afford to buy them. If rents go through the roof because there's less rental stock, that means less people will be able to actually afford it. Does that create higher homelessness? Yes. Does that create higher crime? Yes. So all these things will flow onto each other if this thing isn't fixed, you know, and like we have a vested interest in wanting to see growth. Like obviously I want all my clients to make as much money as they can. You know firsthand how committed I am to that side of things. But like, you know, is there a limit to how silly some of these things can get to as well? And I believe when the federal governments who just don't understand this thing get at play and put their hands on this stuff that they don't understand, every time government tries to create change in policy in the housing market, they create additional demand. It's additional stimulus. You know, let's just take their hands out of the pie, man. Just let it operate the way it always has.
It was so funny. There was a Facebook post from Claire O'Neill, the housing minister. And,
I called her out on the last podcast.
Yeah. And she posted, what was it? It was like this meme or something. Everyone's dancing, like a TikTok dance.
We should pull it up, man. I'll comment on it.
We'll get it up. Maybe we put it in the show notes. Where they're, I don't know, doing some dance. They're like, oh, you know, we've saved, the 5% deposit scheme has saved young Aussies like 200 grand. I'm like, you know, what figures you just pluck in from? Yeah. So I went onto this KPMG report, which he was sourcing, and it was just all over the joint. It was all over the joint. So it was a combination of the amount of rent you've saved by getting on sooner. And then they also put in capital growth into this, you know, $200,000 or $160,000, $200,000 figure, where they said, by getting on sooner, you leverage Australia's average 7% per annum growth. I'm like, but 90, I don't have this figure, but I would say a very high majority of people on the first home buyer scheme, in particular in Sydney, probably Brisbane and Southeast Queensland now as well, increasingly Perth, they would be buying units. You've applied a 7% growth metric to units which have a very low single-digit growth across the country. So you've applied the wrong growth metric to the wrong asset class, and you're telling these young people that they're going to make a bunch of money from it. You're just lying, for starters. The second is the next paragraph highlighted exactly what you've highlighted with the 5% deposit scheme, which is what it did by so much fanfare of it coming out. The second October 1 hit, there was such a rush that between October to December last year, 10% of house sales were under the 5% deposit scheme. You just create this artificial rush into the market, which has lifted the entire thing.
You know what the other thing that isn't thrown into those numbers as well is how many investors rushed in when it was announced,
100%.
let alone when it came into effect. Like let's if they rewound it and go, okay, well, what's the level of investment pickup between when it was announced and then that December 1 as well? Let's overlay those numbers on top of the 10% of first home deposit scheme. Now we're probably talking 50% of the markets sub those price points in those areas.
100%.
You know what I mean?
Yeah.
So it's like, man, like they don't apply like you said, they've even applied incorrect metrics to the incorrect asset class, let alone, actually looking at what's actually going to genuinely happen out there in the marketplace by creating demand like this. And the dumb thing is they bring that stuff in, the investors get in before the home buyers even get in. So then the home buyers are actually paying more.
They're buying an inflated market.
Exactly. You know what I mean?
I mean,
and it just, man, it's a whirlwind that just keeps fueling itself.
I'm sure, and now you don't have to give the details, but I'm sure like APS would have seen a lot of very smart investors come to them. Or, you got a lot of people, you got hundreds of people that come through again every year, right? You would have had a lot of very smart investors say, I'm seeing the writing on the wall here, 6 months before. Because they gave a long lead time.
It was silly, man.
Everyone being like, I'm going to get the half a year jump on the 5% deposit. Well, we did it, right? Everyone did it.
Yeah.
But you did have a roundtable recently with your team talking about there being 36 months left. You touched on it a little bit before, but what does that mean? Are we expecting there's 3 years of quite strong growth and then afterwards plateaus? What do you and your team mean by the 36 months metric?
It was a very interesting conversation. Went a lot of different ways, kind of which we sort of, I guess I went on my little tirade before about things as well. But I think the simple fact is that two-class economy we're talking about and that literal generational wealth gap. I've never been one to advocate it. I've always been like, nah, it's not coming. There's nothing strong enough at play that's going to create a nationwide gap. And then they brought this in, right? And then they're talking about the things like CGT changes, negative gearing changes, all these different things, man, like that on face value, it might seem like they could work. The issue is fundamentally they changed the fabric of the way the game is played. That's been in effect for 40 to 50 years, right? You bring these changes into effect, you change the way that property is done in Australia. That never ends well, right? It never ends well. And so that's what we were talking about before. And like you said there, Phil, man, he's had multiple conversations and spoken about this as well before. It's, man, like we've already seen, like you said, there was 6 months before that change even came to effect, where I reckon the market did 10 to 20% depending on the areas at that time. There was already demand in there. You just threw jet fuel on the fire that was already there, right? Turned into a freaking bushfire, and then we've got obviously the time that then the first home buyers actually entered the market, which is still it's been 6 months at play now as well. Man, I genuinely believe we're going to create this divide, and I think the other component that's going to come with it is exactly as I explained before, the rental side of things. I believe rents at these same price points are going to get driven up because people will be like, well, I can no longer afford to buy at this price point or at this amount. Even just that alone will drive more people into that create. Obviously, if a lot of home buyers are buying investment stock as well, it's going to eat up investment stock, which is going to eat up the rental pool, push it higher and higher from a rental perspective too. Let alone if they do bring in changes like negative gearing would be the worst thing that happened to this to the Australian market if they bring that in on top, because you're literally going to eliminate so many investors that rely on that to maintain the cash flows to be able to hold that. So once you take that out of the marketplace,
but it's the institutional investors that can hoover up the sale.
Well, it's a mix, man, because like it will create less demand from an investment perspective to an extent and for a period. But what will happen is even if the first home buyers are sitting in the wings, waiting in the wings for things like changes like that to come into effect, man, they buy out all the rental stock, especially at the lower price. Let's say sub $1 million right across Australia, it turns to a 80% owner-occupier rate and 20% rental. Man, the way that rental growth would spike after that fact, it probably would become cheaper to buy again than it would to rent because there'd be so much demand on it because there'd be so few rental properties. And they will just create this continual pinball effect of going bang, 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 higher and higher across all facets of the market. So this is what I'm saying, man, is like when they play with things like this, like they act as if it won't create stimulus. We've seen firsthand the stimulus it has created. These other things, these other talking points they're talking about bringing in, the negative gearing, the capital gains tax, all that sort of stuff, it will create that. So when I talk about the 36 months, and this is something that I think people should like really be poignant on it and really sort of understand that, like, if you have the ability now and you're uncertain, the government has already shown they don't understand the way the game is played. And they're just going to keep throwing fuel on the fire that keeps what they think keeps getting them votes by changing this thing, changing that thing. And it probably will in the short term. But what'll happen, and what we're already seeing come to effect, is this nationwide boom at certain price points in the marketplace that will create a floor that we've never really seen before. And I think that will have a flow-on effect to rents. And I believe that it will create a serious wealth gap and a wealth divide.
Yeah.
And again, this two-class economy of the ones that have and have not. And I've never said that before. I've so many times, like, people have asked me about that, and I've rebutted it for a decade, man, probably, right? But now I can actually see where it could happen, right? And it's uneducated governments making uneducated decisions, playing with policies they don't understand. They don't understand the knock-on effect of it, right? And the longer-term knock-on effect of it, like we've already seen with this in play for 6 months. So, man, I genuinely think that's what's going to happen. And this is why we're all talking about it, going sort of in circles, sort of giving our opinions away the way that we think it's going to play out, and making additional changes to the way property investing is done in Australia. CGT discounts, negative gearing, change all that sort of stuff. They need to let the market play out as it is. We've already got a massive supply deficit. We've already got massive demand now, the 5% first home deposit scheme on existing properties. If they change anything else, man, they're just going to create more fire on the fuel that they just don't understand how it's going to play out. So when we say 36 months, this is where we honestly believe the way the market's playing out right now, if you buy the right asset in the right location, of course, always at the right price, I believe the window to make significant wealth over the next 12, 24, 36 months potentially has never been as big as it is right now. And I haven't said this the whole way through the pod. I've sort of tried to avoid saying that too much with what it is. But the harsh reality is, we're with the government. They don't know how to handle the housing crisis in right now. They're making rash decisions that they don't understand how to make sense of. You got the International Monetary Fund, who govern economic policy right across the world, coming out saying, you guys don't know what you're doing. You need to stop doing this stuff with the market. You need to change things like the 5% deposit scheme, like warning the government and warning effectively the Australian people of what's coming. This is what I think is coming. I don't think the government will change these policies. Like you said, they got some dancing meme that they think they're helping people. The gap that they're creating is going to be so substantial. I think it will. This is where a huge amount of wealth is about to be created in the next few years. This is Phil. Like you said, man. I haven't even spoken to Phil about this. We're both shooting from the same hymn book. We've both been investing for nearly 20 years. Well, I think he's probably been even longer than me, but I've been investing for nearly 20 years now. 17 years in the game, man. This is the most reckless thing I've ever seen come into effect. And when a government is reckless, man, that is the opportunity. That is where huge opportunity to make huge amounts of money is. So I think it comes to the proper positioning in marketplaces right now is an incredible time to make an incredible amount of wealth.
Australian property investors are, I think, a lot smarter than the government gives them credit for. And I can't necessarily work out, and not to labour the point too much, but I can't work out whether, capital gains is it's to help first home buyers get achievable homes, or if it's to raise money for government coffers, or if it's some punitive measure to attack investors and make them pay more. But when it first came out, or when the whispers first came out that the government was looking to reduce the CGT discount, I said to my wife, should we start buying? And she just, literally, I'm working from home, and she just turns to me and she's like, just don't sell it. And I'm like, of course. And then the solution in 30 seconds was like, don't sell, hold on, which ties into everything that you said, Sam, which is sophisticated investors don't sell, you hold on, there's less stock on market, price actually goes up because the demand's still there from the first home buyers. And with negative gearing as well, you also highlighted
one quick thing I'll note on that, sorry, just before we go into that, is sophisticated investors will know how to mitigate the tax anyway, so we pay barely anything extra. Just to throw that in there on top. You hold longer because everyone, there'll be this period where things do change. Hold longer, prices will continue to increase because they're changing, again, the fabric of the way the market is done. Go longer, and then those of us, which we already know, man, I know the way that we've built your portfolio, it's not going to change much. I told you when you asked me straight away off air, I go, we're going to do this. It'll cost us a tiny bit extra from that perspective. It also, rents will go up. So you're actually going to make up the shortfall from that little bit of extra tax with that. And when I say a little bit extra, I'm literally talking a very minimal amount extra. We're not talking the double rate they think they're going to sting you with. I didn't mean to cut you off, but I just want to throw that in there.
No, and I think that's very wise. And with the negative gearing, I highlighted cost of doing business. It's a cost of doing business. 50% of investment properties in Australia are positively geared. That's not going to impact them at all. And if you are positively geared, you're going to get the benefit of higher rental income going forward anyway. So this is baked in. Now, Sam,
that's just one last thing I was going to finish off with. That's exactly what I was going to say, man. If they pulled negative gearing, I guarantee you within 12 months, all of our rents are up $100 a week across the whole property, the whole country, man. That would happen without a shadow of a doubt, because you get people who panic, people who would no longer buy. You're going to create a massive deficit in the stock pool from a rental perspective. That's going to put pressure on prices, or pressure on rental growth. Man, we're all going to make more money out of it. Like as I say, government, stop touching housing policy, because you're making it worse. Yeah, it's good for us. It's good for us.
The grandest irony is, if you're disincentivizing people from selling, right? You're disincentivizing investors from
people from holding property.
Right? And so you're like, okay, cool. I actually want Sam to hold his portfolio, right? And I'm going to disincentivize him from selling. Like, this is a really radical idea. But if you actually want to increase housing stock without punishing investors, lower CGT to 0% if you put one property on the market. Yeah. Now that might have those flow-on impacts as well. But if you're actually looking to enable young Australians to get on the housing market cheap for their PPOR, don't disincentivize the selling. Encourage the selling.
Can I give my 2 cents for 1 second? Yeah. Just stop touching policy. Just don't do anything, man.
So,
just leave it. You know what I mean? Like this is everyone's trying to find the solution. Yeah. Mate, the market has worked in its peaks and its troughs, and it's the way that it's worked forever. For 150 years, they've got the data, the way the markets work in their peaks and their troughs. Everyone needs to stop touching it. Yeah. Let it play out the way it moves. And markets reach the peak of their affordability. They taper off because no one else can afford to buy there. Yields turn to shit. Owner occupiers can't afford to buy there because it gets too expensive. Then it peaks off. Then it troughs for 10 years. And then it booms again in 4. Like it's almost like clockwork. These like circa 10, 15, 20-year cycles, depending on the time, depending on what else is at play, like geopolitically, worldwide sort of thing as well. But then outside of that, man, like just let the market do its thing.
Okay, so the world, according to Liam, never put me as housing minister. Now, Sam,
but you think in the right vein, but it's the same as like they're trying to do their thing on that end, and then you're trying to do the right thing of like thinking of bring more stock. It's just like, man, the market works. You know what I mean? It works, man. It's the same as Phil was saying. You said in another podcast, like, the way it works is fine. You know what I mean? It's like it just needs to be left to do its thing, and not, especially things like this, man, like stimulating it from those examples of all these different things, man. They just need to let it play out the way it always has, But I do have one more question for you, because we didn't get to touch on it earlier. Now, it's probably going to have to be a rapid fire one, because I know you've got a few things to do today. Darwin, the Darwin market, mate. I've seen you on social media. You've been cruising around Darwin talking about... Mate, give us a little bit of the inside scoop. Look, okay. So the reason why I did this, because a lot of people ask me about this, like, why did you actually, because I've never talked about locations before, right? And
I was surprised about that, actually, because I was like, this is the first time that he's kind of gone public.
So, very simply, the amount of people that went out there and canned Darwin, and I'm just like, it just made me angry, man. You know me, sometimes I'll fire up and I'll go, you know what?
Yeah, I've seen it once or twice.
Man, I'm like, I'm just going to do this. You know what I mean? So I got up there, man, got on the ground. And, man, what a lot of people don't realize is, they say there's nothing going for Darwin. It has the highest infrastructure spend per capita in Australia by a country mile. It has, everyone thinks of the ACT as, the IT hubs, or not the IT hubs, the
data centers?
The government centers.
Yeah.
It's just as high in NT, mate. Like everyone up there is bloody government employees. There's these huge projects going on. It's got the largest solar farm with 100 kilometers of Darwin, largest solar farm in the bloody Southern Hemisphere. It's a $30 billion project. They've got billions of dollars being pumped into the actual, CBD and different projects going in there. They've got a joint project with the US Army. They're building some monstrous base up there as their Southern Hemisphere defense point against the Chinese. I think if anything was to happen and escalate there, man. And the one thing that a lot of people forget is it's a pressure cooker of a market. It's only 140,000 people, So, when you sort of combine all that stuff on top of this enormous infrastructure spending, mate, talk about yields. Like, you're getting yields in the 5 to 6% still up there. Stock has absolutely fallen off a cliff. And, mate, you know who we compete with more than anyone up there? Owner occupiers. Yeah. Most active segment of the market in Darwin is bloody owner occupiers. They're all out there. They're passionately defensive of their bloody city, and they're trying to buy as much stock as they can. They're all trying to get in themselves into the marketplace. Yep. And it's a funny thing, man, because like, I see these people come out and they tout, keep buying in Melbourne forever and keep buying in Sydney forever. And I think it's just one of these things, man, like the affordability ratios are so shot there compared to a city like Darwin. And man, in reality, I looked at Darwin very similar to a lot of the regional centres that we used to buy in, and that we're big advocates for as well. And mate, that have doubled and performed more than doubled in their markets, and I believe still have growth left in the tank. And you're talking about a capital city with 30 billion plus, 40 billion plus sort of spending in the pipeline, and it's like, why wouldn't you? You throw on again the 5% deposit scheme that has just been increased to 750k, so it was at 600,000, now it's at 750,000.
So they upped it.
They bumped it. Well, it was the only capital that they didn't increase. So every other capital they increase, and then I think the
they read the writing on the wall.
Yeah, I think the NT REA or whatever it is, REI and NT or whatever, I think lobbied for it because they're like, well, no first home buyers can get into the marketplace because of where it is. So they bumped that to 750. Man, it's just like there's so many things going for that marketplace, and that's why I just sort of laugh when these guys and girls sort of come out there and can it. And let's look at the data at the end of the year and see where it ended up in a growth rate.
Yep.
And I think it will outperform every market in Australia, or go very, very close to outperforming every single marketplace in Australia.
We'll hold you to your words.
Man, we'll see. Yeah. We'll see how we go. We'll come back at the end of this year. But if it wasn't top 3 capital city, if not number 1 capital city at the end of this year, I'll be very, very surprised from a performance perspective as well. And I think there's a lot in the tank.
Yeah.
I looked at all these cities before I entered in Brisbane. I did Brisbane, then I did Adelaide, then I did Perth, and all of them were exceptionally tight from an affordability ratio and had so much growth in the tank. And they're all still running 4 years on, 5 years on. We're in this, we've just entered the second year of growth in Darwin. I think it'll do 20% plus this year. Maybe it might even hit, it's a citywide average, but I think it'll do 20 to 30% this year. And I think it'll keep producing over the next few years as well, just because there's so much in the pipeline. There's so much owner-occupied demand. And the rental market, super, super tight vacancy rates. I'm a big believer in it, man. I think it'll do well. And I've never come out openly and talked about areas that I believe in. But just there's so many people canning it, and they're just people I just don't agree with their opinions with. Yeah. And I'm like, I don't agree with you as an investor. I don't agree with your opinion in general about anything really.
So you've come out swinging. You're correcting the record.
100%, man. I was like, man, I don't know. People did it sort of backhandedly about some small towns that not small towns, but like 50 to 100,000 population towns that we got into that doubled or more in a 3-year window. And I'm just like, it's the same. I think the market will very much do the same there or better. So, man, I'm a big believer, and I think it's still got a lot of growth left in the tank. I'm still buying properties there myself at the moment.
On that note, Sam, I think that's all we have time for today. Thank you so much for joining me on the podcast.
Liam, always a pleasure, mate. Thank you.
That was Sam Gordon from Australian Property Scout. If you want to get in touch with Sam or his team, make sure you reach out via the APS website. But that is all we have time for today, and we'll be back at the same time next week with another episode. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.